Welcome back to G-Bound Republic. Thank you for joining me. Tonight, we're going to have the most important broadcast that you're probably ever going to see. We're going to answer a lot of questions about our financial systems. We're going to do some deep diving and dig up a lot of jewels that are hidden within our financial system also. There's a lot of remedy to be had as far as discharging debt. And a lot of people have heard that our debts are already prepaid, but nobody's actually really shown you how or why they're prepaid and then how to apply that prepayment. Because now, in present day America, nowadays you see that the corruption is blatant and is nationwide. Okay, these corporations are not your friends. The government is not your friend. The only friends that you have are your neighbors that you're told to love. So I suggest you share this with your neighbor and let's come together on common ground that we all need relief from the inflation that's taking the nation by storm. So first, we're going to answer a question about how our debts are prepaid and how did this come about. Now, you have to understand that everything that you sign when you're contracting out here in the world, any kind of account that you open is a financial asset. But first, before we go into financial assets, we're going to look at the Emergency Banking Act of 1933 that happened on March 9th. All right, now this is from the Congressional Record, 48 Stat 340. If you get with me, I believe I have this, the whole document is 72 pages, and I have that whole congressional record of this taking place available on PDF for you. So just get with me and we can get you that. We can get you that document. But listen to this. This is quoted from the Congressional Record. The president is allowed to appoint a conservator over the banks to receive deposits for the bank and to separate them from those that have already been received, thereby adding greater security for the man who wishes to deposit from this time on. Then they are allowed two other privileges. They are allowed first to deposit their bonds of the United States government and to receive circulating currency. And then if they have not got bonds, they can deposit their bills of exchange, drafts, and notes and receive circulating currency up to 90% of the estimated value of those securities. I'm going to pause right there really quick, and I'm going to point something out to you that you probably already have comprehended. Okay, so your bills of exchange, drafts, and notes are referred to as securities. All of those are securities. Bonds of the United States government, bills of exchange, drafts, notes, securities. All right, now I'm going to move forward. We have provided that any direct obligations of the United States or any notes, drafts, bills of exchange, or bankers' acceptances acquired by Federal Reserve banks may be deposited with the Treasurer of the United States or with the Federal Reserve agents, and upon these securities, Federal Reserve bank notes may be issued. In case of the deposit of obligations of the government, the issue of Federal Reserve bank notes may be for the entire amount of such. So, getting back to it, you see that your notes or promissory notes are securities. We're dealing in a financial system full of securities. Anything that we sign, and as soon as we sign it and deliver it to whatever corporation that we're doing business with, it is converted into a security. So, how much power have you given away over the years now that you know this? You probably weren't even aware that the banks had this kind of responsibility to us to be able to present our bills of exchange, our promissory notes, drafts, and other things of that nature for full value or 90% of the face value of whatever note that we're signing, right? Probably had no clue. And that's because you've been deemed or you've been presumed to be a merchant. And a merchant is someone who carries himself to be an expert in commercial paper and dealing with commercial paper, because we handle commercial paper every day. And they're not going to tell you because you've been deemed your own corporate vessel. So they want to call it's a level playing field. You're a corporation just like Walmart, just like McDonald's or any other corporation out here. So the responsibility is yours to know your commercial rights and know how to exercise your commercial rights. But they do not make it easy. It is not made easy for you, not one bit. So moving forward, we're going to jump into the monetary system and our currency and what exactly our currency is defined as. Because it's not on the gold standard anymore. It hasn't been on the gold standard since 1933. And the effects of taking the currency off of the gold standard being backed by gold is that he who has the gold pays the bills. They can't take the American people's private contractual remedy away as far as dealing with silver and gold as constitutional money and not providing a remedy for the people. So, in that Emergency Banking Act, that was a remedy that was provided by the people. But it wasn't exactly explained to the people. A lot of times these bills are passed and they're not even read by Congress. A lot of this stuff is passed and it's not even read. It's just pushed through because that's what the powers that control the government want in play. So that's what happens. All right, so we're going to look at the meaning of de facto currency, because that's what we're operating under is de facto currency. All right. De facto currency. A de facto currency is a unit of money that is not legal tender in a country but is treated as such by most of the populace. The United States dollar and the European Union euro are the most common de facto currency. So when we talk about currency being de facto, we have to ask, okay, if the currency is de facto and it's not constitutional money from a de jure government, then the government also has to be de facto. It's not a de jure government if we're calling it a democracy, or if we're calling it a what do they call it? A democratic republic, which is an oxymoron, or any of those, anything involving democracy. It's a de facto government. It is it's a takeover. It's a coup. It's not a real government. They're just actors acting as government officials, but all of their seats are vacant. I promise you. So moving along, we're going to go into the powers and the duties of a bank, right? Because when you went to apply for your mortgage, your home loan, they told you that, okay, well, the bank will loan you the money and you can take possession of the house upon the approval of your mortgage, right? Okay, well, we're going to look into it a little bit. We're going to jump into, this is a part of the banking code, 12 United States Code 1431, which is the power and duties of banks. All right. Powers and duties of banks. A. Borrowing money, issuing bonds and debentures. Okay, the general powers. Each federal home loan bank shall have power, subject to rules and regulations prescribed by the director, to borrow and give security therefor, and to pay interest thereon. Excuse me. To issue debentures, bonds, or other obligations upon such terms and conditions as the director may approve, and to do all things necessary for carrying out the provisions of this chapter and all things incident thereto. So, if you don't get it, I'm going to run through it one more time for you. Powers and duties of banks. Borrowing money. So who are they borrowing money from? They're borrowing money from you. Once you sign a promissory note or a promise to pay, it is treated as a deposit of cash. So they take the promissory note, since you didn't provide an endorsement or any instructions with it, they endorse it. And they provide instructions before they send it off to a special purpose vehicle for securitization. Okay, so their powers are to borrow and give security therefore. So who are they giving the security to? They're giving the security to the Federal Reserve Bank that they're getting the funds from after they get your note. Remember what's happening. Your note is being taken to a Federal Reserve agent or to a Federal Reserve Bank, and to give security therefore, right? So they have to give security for the full value of the note or collateral security, right? And to pay interest thereon. So they're paying the interest that's due by them to the Federal Reserve. They're taking that debt that they owe the Federal Reserve and they're giving it to you to issue debentures, bonds, or other obligations. Now, these debentures, bonds, and obligations, these are the bills that you receive or the statements that you receive that you think is a debt to you. You're taking on an obligation that you have no idea that you funded. So if you're funding your own obligations, who are you in debt to? All right, so moving forward, we're hearing this word obligation of the United States, right? We're hearing this quite a bit. So we're going to move on to what obligation of the United States is. One second. United States Code, subsection 8. Obligations or other security of the United States includes all bonds, certificates of indebtedness, national bank currency, Federal Reserve notes, Federal Reserve Bank notes, coupons, United States notes, Treasury notes, gold certificates, silver certificates, fractional notes, certificates of deposit, bills, checks, or drafts for money drawn by or upon authorized officers of the United States, stamps and other representatives of value of whatever denomination issued under any act of Congress and canceled United States stamps. So, when you go to do a administrative process to discharge any debt with a promissory note or with a bill of exchange containing whatever bill or whatever the obligation is, and they tell you they don't accept that, why are you accepting that as an answer? Well, for one, they're telling you they don't accept it because the credit is already there. Only thing you have to do is express your interest in the credit. But we don't know these things, right? So, we live and we learn. And they do absolutely accept those things because they can take those items, monetize them, and still come after you for the debt because you are not expressing your interest in the other side of the ledger. Now we're going to go over a couple parts of this United States Code section. One part that we're going to look at is, Treasury notes. United States notes, right? Treasury notes. Did you know that your court case that you're involved in from the ticket that you got from the cop that pulled you over, did you know that that was a treasury note? It absolutely is. If you take that treasury note or that court case number and you plug it into Treasury Direct, you put it into their bond calculator, you're going to find that this indeed is a treasury note. It's a security. And that security is being traded. And that's why the cops absolutely want to meet a quota, because the prosecutor is telling them, hey, look, everybody knows what's going on. So you get a ticket, the prosecutor comes in and prosecutes, he's the one that put the cop up to it in the first place, the county attorney. So the prosecutor comes in and enforces this to take those notes and make treasury notes or treasury bonds out of these things. Okay, so your bills, we're going to skip down a little bit. Bills is plain as day. There's nothing to hide. Bills, checks, or drafts for money drawn by or upon authorized officers of the United States. Okay, drafts for money drawn by or upon authorized officers of the United States. Did you know that your name, that you are considered an authorized officer of the United States? Did you know that's what United States citizenship is? It's an office, and you are the occupant of the executor's office. So if you draw a draft for money, you're the authorized officer of the United States that is able and has the ability to do that. Okay? Okay, stamps and other representatives of value. This is a pretty vague statement, right? Other representatives of value, which could be a promissory note, any kind of evidence of a debt, right? Of whatever denomination, issued under any act of Congress and canceled United States stamps. So when people tell you to write your name diagonally across the United States stamps, therefore canceling it out, yes, you become the postmaster general for that contract. You become the postmaster general of that contract. That canceled United States stamp, whatever denomination is on that commercial document, you are the owner of it, and it has to be accepted. Just like, I don't know if you remember the movie, I think it was John Travolta, From Paris with Love, and they couldn't get these cans through the French agents, the French border agents, right? So in order to get the cans through that had all his weaponry in the cans, what did he have to do? He took out a bunch of United States stamps and put over the cans. He put them on all of the cans, on all of the packaging and stuff, right? So at that point, it had to be accepted. Why? Because the whole world deals in United States dollar. So any United States currency has to be accepted. So those stamps were a denomination of value that had to be accepted. It's a slick game out here, right? Yeah, but we're going to continue on. But the next thing we're going to look at is 31 United States Code, subsection 1501. And we're going to look at this code section because this is going to blow the doors wide open of what the prepayment of debt, the whole prepayment of debt, it really hinges upon this code section. All right, documentary evidence requirement for government obligations. Now, we just looked at what obligations of the United States are, right? So bills, checks, and we seen everything that's on that list. Everything that's listed are obligations of the United States. They are not your obligations, okay? I need you to get that. But here, documentary evidence requirement for government obligations. So this is a good code section to use if there's any kind of discrepancy or mix up about what's considered a government obligation, right? So you can use this code section along with parts A, B, and C, whatever part that correlates with the item that you're looking to have enforced. Okay. All right. So we're gonna move on to A. An amount shall be recorded as an obligation of the United States government only when supported by documentary evidence of 1. A binding agreement between an agency and another person, including an agency, that is A. in writing in a way in form and for a purpose authorized by law, and B. executed before the end of the period of availability for the obligation of the appropriation or fund used for specific goods to be delivered, real property to be bought or leased, or work or service to be provided. So this is saying it has to be executed before maturity or before closing, if it's real property, or before your billing cycle or maturity for whatever utility that this might pertain to. All right, 2. A loan agreement showing the amount in terms of repayment. This is documentary evidence of a government obligation. A loan agreement showing the amount in terms of repayment. Okay? It's plain as day, right? All right, 3. An order required by law to be placed with an agency. Okay, so what would that be? Any kind of order, any kind of court order required by law to be placed with an agency. So wouldn't a child support order fall under number 3? And what agency is it placed with? It's placed with the Child Support Enforcement Agency, right? So this is a government obligation, right? Okay, is it your obligation or is it the government's obligation? 4. An order issued under a law authorizing purchases without advertising. A. When necessary because of a public exigency. I'm sorry, public exigency. I'm getting tongue-tied. But B, for perishable subsistence supplies, or C, with specific monetary limits, right? So as long as within specific monetary limits for perishable subsistence supplies, or when necessary because of public exigency, all of these qualify as what? As government obligations. 5. A grant or subsidy payable, A, from appropriations made for payment of or contributions to amounts required to be paid in a specific amount fixed by law or under formulas prescribed by law. We're just going to keep moving forward. B, under an agreement authorized by law, or C, under plans approved consistent with and authorized by law. 6, a liability that may result from pending litigation. So what would that be? Remember we talked about that speeding ticket? If you get a speeding ticket from a cop, right? Isn't that a liability that may result from pending litigation? If you get a speeding ticket, isn't there a liability that is going to arise pending the outcome of that litigation? And that's not just traffic tickets. We're talking anything. Okay, a liability from pending litigation. That would be the conception of your child support order. It's a liability that may result from the pending litigation, right? This could be your criminal court case, right? It could be your civil court case. If somebody sues you for $100,000, right? This is the liability that may result from the pending litigation. So what is it? It's a government obligation. 7, employment or services of persons or expenses of travel under law. These are government obligations. 9, other legal liability of the government against an available appropriation of fund. Right? Stay with me. B, a statement of obligations provided to Congress or a committee of Congress by an agency shall include only those amounts that are obligations consistent with subsection A of this section. Right? So I hope you guys are taking notes. All of my videos, presentations that I put out, I highly recommend that you take notes. You have to take notes on this stuff. This is the most important shit that you're going to deal with involved in your life. You know, everybody's being taxed to the brim. Everybody is suffering from inflation. I don't know, too many people rich is just balling like that is not being affected by this, and even if they are, look, this is a way to build wealth. Even if you are paid and it's not affecting you, this is just another way for you to build wealth for you and your family instead of building wealth for these corporations that are robbing you blind and could care less about you or your family. You feel me? So use this information and use it to your advantage. They're not going to like it. They're not going to like you using this stuff to your advantage. Because why? Because they're capitalizing off of your ignorance. That's why they won't tell you about this. That's why they won't tell you anything about none of this stuff going on at all. All right, but we're going to move forward. Next, we're going to check out another lethal code section. But first, we're going to look at a definition of something real quick, because we looked at the obligation of the United States, and then it mentioned something about drafts for money, right? So a draft, do you know what a draft is? Because if not, we need to know what these words mean. Now, I provided an entire playlist of what a lot of these words mean in the What's the Word playlist on the YouTube channel. So go to the What's the Word playlist and be sure that you save that to your playlist and study those definitions. All right, so the definition of draft. A draft, also known as a bill of exchange, is a traditional, long-standing trade instrument which has been used across the globe for hundreds of years. So this is a bill of exchange, right? So this is saying, okay, well, A is going to order B to pay C, right? So in this case that I'm going to give you an example, A would be you, right? B would be the Secretary of the Treasury or your county treasurer, right? Those are the trustees for the bankruptcy, the reorganization plan number 26. Okay, so C would be whoever is claiming to be a creditor, right? And that's the order of your bill of exchange. And the thing is irrefutable. It's irrefutable. And as long as you record everything in the commercial registry via UCC1 financing statement, you want to record all your transactions. That way you have a commercial record of all of this stuff. People that tell you that you don't need to file UCC, yeah, you don't need to file a UCC1 to do any of this, but in order to prove any of this and to do good accounting and to do good business, you want to have your own records. And the only way to really do that and to capitalize on it fully is by having a UCC1 financing statement and also having expressive security interests and agricultural lien interests in all of your assets. Okay? I mean, that's just the bottom line. There's no getting around it. It's just the best way to do business. All right, so the next thing we're going to look at is going to look at the definition of issue, because that word also came up as far as the bank's power to issue debentures, right? It said the bank had the power to issue debentures and bonds, etc., right? So let's look at what issue means. Issue: the first delivery of a bill or note, complete in form to a person who takes it as a holder, right? So this is where the contradiction and the conflict is going to come into play, because who is the issuer? If you're the only one signing the note, right? You're signing it as maker, drawer. You're signing it maker, drawer, acceptor. So you delivered that bill or note to the corporation first. That's the first delivery. It's complete in form because you signed it. Your signature's on it to a person who takes it as holder. So who's the holder? Whatever corporation you're doing business with, whatever bank that's claiming to give you a loan for whatever purpose, those are the holders. It's very important that you know who you are in these transactions. You're the first one. You're delivering the bill of exchange or the draft for money, right? Or the promissory note, complete in form to a person. And remember, a person is a corporation who takes it as holder. So, if you're giving that corporation a note or a bill, isn't that similar to you giving the bank money? Isn't that about the same thing? Isn't that equivalent to you giving the bank money? It sounds like it to me. I mean, I don't know about you, but a promissory note, if you know it has value, it's money. All right? So next we're going to look at the definition of financial asset. But first, before we go into that, we're going to look at a few definitions of very important financial terms that, like I said, you better be taking notes on this stuff. You feel me? This video is, I'm giving you the jewels. I'm giving you everything that you'll possibly need to understand this stuff. And you can learn this stuff at your own pace. But I suggest you pick up the pace and take this shit serious, because it's not a game out here. Life is not a game. And if you do look at it as a game, isn't it a game that you want to win before it all goes back in the box? So I hope that you take this serious, because this is what's going to affect the outcome of your financial future. And if you care about your lineage and care about your bloodline at all, this is what's going to affect them the most, is you doing something right now and learning this stuff right now, so you have something to pass down. Because wisdom is worth more than any rubies, gold, is worth more than anything else that you could possibly put your hands on. So it's important that you take that wisdom and you use it to your advantage. Because if not, you see the writing on the wall. You see it. All right. Financial asset, except as otherwise provided in section 8-103, means a security. There it is again, right? 2, an obligation of a person or a share, participation, or other interest in a person or in a property or an enterprise of a person, which is, it is of a type dealt in or traded on financial markets, or which is recognized in any area in which it is issued or dealt in as a medium of investment. Or 3, any property that is held by a securities intermediary for another person in a securities account, if the securities intermediary has expressly agreed with the other person that the property is to be treated as a financial asset under this article. Okay? As context requires, the term means either the interest itself or the means by which a person's claim to it is evidenced, including a certificated or uncertificated security, a security certificate, or a security entitlement. Okay, so we're going to break this all down. We're going to chop this down for a minute. Okay, so first, an obligation of a person or a share, right? Financial asset. If it's an obligation of the name that you were assigned, the estate was your name. It's yours. People call it straw man. Some people call it ins legis. It's an estate. It's your name estate. Okay, if it's the obligation of that person, it's a financial asset. Okay, it is of a type dealt in or traded on financial markets. Okay, first thing you must understand, once you sign that financial asset and it's taken and deposited as cash, it is converted into a security, right? First, it hits the primary markets, and these corporations issue your securities as financial assets to be traded on, right? And then it hits the secondary market after somebody else buys that asset, buys that financial asset, which could be your light bill, it could be your mortgage, it could be any kind of obligation, phone bill, it doesn't matter what it is. It's dealt in as a medium of investment at that point, right? Okay, so if you break down 3, any property that is held by a securities intermediary. So, okay, it's held by a securities intermediary. They're the holder, right? They're the holder of a security that you issue to them, right? For another person. So they're holding it for you in a securities account. But this is if the securities intermediary has expressly agreed with the other person that the property is to be treated as a financial asset, right? So they told, okay, the SEC, this is to be treated as a financial asset. But they've never told you that this was to be treated as that it was a financial asset. Why? Because you are presumed to know already that you're giving them financial assets and you're giving them power of attorney to do whatever they want with your financial assets. Okay, so as context requires, the term means either the interest itself, so this is interest. It could be just mean the interest in something, or the means by which a person's claim to it is evidenced. Okay, including what? Certificated or uncertificated security. So your birth certificate is a certificated security. If you didn't know, that is your evidence that you have a claim to whatever that obligation is. An uncertificated security would be a driver's license, ID card that has that name on it. That is your claim. That is your evidence of your claim to these securities that are being issued. And if you file a financial statement expressing your security entitlement to your instruments, it's undeniable. It's undeniable. So what happens once you do this? What's supposed to happen after you do this, right? That's probably the question that you're asking. Okay, so after you do this, you express the interest in your assets. You get what is called a right to set off. Because you also have the right to redemption. You have the right to redeem your assets as well. But we'll get into that another day. I advise you to subscribe to the channel for one. For two, stay posted because we are releasing the course, the course that's going to explain everything from A to Z this month at the end of September. I wanted to wait till month number 9 to release this. And there's a lot of symbolism that goes into that also. But regardless, the course will be released, I want to say, by the 29th of September. So, the right to set off, though, we're going to go into that right now. But you also do have the right to redemption because you've redeemed your securities, and that plays into applying the set off. Okay, the right to set off is a legal principle that allows one party to offset mutual debts with another party, effectively reducing the amount owed by deducting any debts owed to them. Right? Okay, so you might thinking, okay, well, I got this bill for $400 in the mail, so where is the debt that they owe to me, right? You're probably thinking, because you're thinking in your poor little indoctrinated heart that, okay, you owe them $400, right? Well, they've already received the $400. They're giving you pretty much an invoice of the credit that they're using in those financial markets, okay? Because you set up this account, you've given them a Social Security card, which is a credit card, because that's how they access your credit in the first place. So you've given them the assets already. They have the financial assets, and they're just giving you pretty much an invoice of the credit that they're using of yours. But if you want to act as the surety for these obligations, they're not going to tell you no. They're not going to say, hey, you don't have to pay this. They're issuing it back to you, telling you what they've used. But it's a credit. It's $400 of the credit because there is no actual real money, and they cannot charge you in a bankrupt system. A corporation cannot charge you anything. They're insolvent. Every corporation, including the government, they're running under a Chapter 11 reorganization, and they are debtors in possession. What are they in possession of? They're in possession of all this tax contraband that they're holding because nobody knows how to claim their credit. They're in possession and holders of your financial assets because you don't know how to express the interest in your financial assets. So you have this right to set off the debt that they allege that you owe against the debt that they actually do owe you, because they're using your credit, they're using your assets. So in accounting, if you have a $400 debt or debit on one side, the matching principle says that you have to have a matching $400 credit on the other side. That's the way it works. The credit was already provided, and you can't get a debit or a debt unless you have a credit previously issued. So the credit was prepaid, the credit was already provided. So that debt comes from the credit, which gives you the right to set it off. And on top of that, once you claim the redemption of your securities or your financial assets, you're entitled to the proceeds of what these things are trading on the market for. You're entitled to all the proceeds. However, nobody knows this, but you can also give instruction to have the debt that they allege that you owe be set off from the amount of the proceeds that is owed to you. There's a lot of different ways you could do this. There's a lot of different ways to skin a cat in this game. You don't know what the financial assets are, so you don't know how to express your interest in them. Or, hey, well, the assets, you got the assets, well, I want to express my interest in the proceeds. This is the most important stuff that you're going to learn. I promise you. All right, so we're going to look at this mutual offset that we're talking about, right? But first, hold on, before we even go into the mutual offset, because there's a right to set off right here. But before we go into that, we're going to look into monetary instruments. Okay? Just so you get a bigger feel for what monetary instruments are, and to know that you have to broaden your horizons on what this stuff is, what this stuff means, because it's it's more than what you think. It's more than just cash. It's more than just the cash you carry around that you put in a bank account. This whole thing is a paper empire, okay? So monetary instruments. A, U.S. coins and currency. B, as the Secretary may prescribe by regulation, coins and currency of a foreign country, traveler's checks, bearer negotiable instruments, bearer investment securities, bearer securities, stock on which title is passed on delivery, and similar material. C, as the Secretary of the Treasury shall provide by regulation for purposes of sections 5316 and 5331, checks, drafts, notes or promissory notes, money orders, and other similar instruments which are drawn on or by a foreign financial institution and are not in bearer form. These are all considered monetary instruments. And if you didn't know, all of these financial institutions that you call banks, that we go to, the JP Morgans and the bank one, well, there's no more bank ones that I've seen in a long time, Fifth Third banks, any of these financial institutions, they are all foreign financial institutions. Not one single financial institution is chartered in America. They're chartered overseas and given their charter clearance through the United States government. All right, so next, we're going to jump into the definition of money equivalent, right? Because, okay, there's monetary instruments and there's money equivalent, right? Money equivalent. I hope y'all are taking notes. And you want to watch this video I want to say at least 10 times. I want to tell you watch it at least 10 times, and I'm not even joking. Okay. Any benefit that is readily and directly convertible into cash or cash benefit, including but not limited to securities, stock options, bonds, loans, promissory notes, or gift certificates or gift cards that have cash value. Okay. But not limited to securities, stock options, bonds, loans, promissory notes. Right? But these are all things that we use on a daily basis. We know what else is a money equivalent? When you get charged, right, with a crime, charged with speeding, what are they charging you under? They're charging you under a statute, right? That statute is a benefit. The statute is a benefit that the U.S. citizen partakes in. The U.S. citizen partakes in that benefit because you have the what? Privilege of driving. So the benefit will be the statute that you agreed to be liable for. If you get caught speeding, hey, well, that's, whatever that benefit is, whatever that statute is, it has a monetary amount tied to it. It's a money equivalent. Because what? What can it be? It can be readily and directly convertible into cash or cash benefit. Securities, right? All of these. And you thought you knew something about money, didn't you? Come on. Tell me. Lie to me and tell me you did. You thought you knew this. Thought you knew something about money already. All right. So now we'll go into mutual offset, right? Mutual offset. Uh-oh. Give me a second. There we go. Mutual offset refers to a situation where debts owed between two parties are settled by deducting one debt from another. This is a general right or legal mechanism where two parties who owe each other money can apply their debts against each other, effectively canceling out mutual debts. Do I need to say more? Do I need to say more? So who's the creditor and who's the debtor in all of this? Who's the creditor and who's the debtor? I mean, you could play both if you want to. But if the government is the primary obligor or the primary debtor, because all of these things are government obligations, why are you paying the government's debts? Why are you paying it? It's a good question, huh? All right, so we're going to move on. Move on. Up next, we're going to look at the definition of escrow. Right? Let's look at good old escrow. All right. Now we hear this word a lot when it comes to dealing in real estate. You know, the opening and closing of escrow. And that closing, that's what closing is. Closing is the closing of escrow, right? That's what it's supposed to be. All right, check it out. Escrow, a written instrument which by its terms imports a legal obligation and which is deposited by the grantor, promisor, or obligor or his agent. This will be you. Deposited by you with a stranger or third party to be kept by the depository until the performance of a condition or the happening of a certain event, and to be delivered over to the grantee, the promisee, or obligee, or this will be the purchaser of the property, whoever's receiving, whatever it is, right? In its origin, the doctrine of escrow applied only to deeds of grant or conveyances of land, but it was soon extended to other sealed instruments and has come to apply to a variety of instruments, including bonds. Listen, bonds, contracts for the sale of land, contracts for the purchase of personal property. So this would be vehicle purchases, corporate stocks, deeds, discontinuances, and releases of cause of action. Sounds like court cases to me, doesn't it? Okay. Contracts for the settlement of will contests, commercial paper, applications for insurance, and subscription papers. And this is from 28 American Jurisprudence, second edition. That's the definitions of escrow and the function of escrow. So anytime you're making a deposit, right? You make a deposit into a bank. You make a deposit into a financial institution, into a depository, right? If you deposit $100 into your bank, what do they owe you? Doesn't the bank owe you $100? So, if you deposit a promissory note or a legal obligation saying that you promise to pay $200,000 with the stranger to be kept by the depository until the seller, right, hands you over the property, right? What else is owed? I'm going to leave that for y'all to think about. Y'all just getting all the good jewels. We sitting in about an hour long. I'm going to go into a few more of the banking functions before we cut this short. And then we're going to jump into some other remedies as well. But, I think I've given you quite a bit of remedy so far just by knowing the definition of words. That's why this is important, and knowing the code sections of the United States Code, which is our banking code, that's available to the people to use. It's here for us to use this stuff, but nobody reads anything, and they presume us to know it, knowing damn well people don't read, and none of this is taught in any school. So they're like, okay, well, good luck. That's why a lot of these people don't even know this. The higher ups may know this stuff. The CEOs, the chief financial officers, they may know this stuff. But then again, you got to think they may not. That's why it's our duty to point this stuff out to them, regardless if they know it or not. Because we can't allow their ignorance to continue to damage us in whatever we're trying to accomplish. All right, so moving on. Exchange. The process of mutual offset can be seen as an exchange where one party's debt is exchanged for the other party's debt, resulting in a net settlement, right? And this is when we get into the accounting part of our monetary function. This is one of the most important things you have to know, that you are dealing in exchange contracts. You're exchanging debts. But you are taking on the duty of an obligor. You're taking on the duty of a guarantor by agreeing to be liable on these instruments. Okay, instead of giving the instruction of saying, I want to exchange my debt for your debt in result of, for the result of a net settlement, right? Well, we're going to look in the net settlement. What does net settlement even mean, right? Well, let's look at it. There we go. Give me 1 second. Here we go. Net settlement. Net settlement is an important characteristic that distinguishes a derivative from a non-derivative because it permits a contract to be settled without either parties accepting the risk or cost customarily associated with owning and delivering the asset associated with the underlying. The underlying is just the actual cost or face value of the financial asset. Hold on, give me 1 second. All right. For example, storage, maintenance, and resale of the asset, right? However, if the assets to be exchanged or delivered are themselves readily convertible to cash, those risks are minimal or non-existent. Thus, the parties generally should be indifferent as to whether they exchange cash or the assets associated with the underlying. Says it all right here. And this is from the Financial Accounting Statements Board statement, Financial Accounting Standards Board, Statement 140, paragraph 265. All the remedy that you need is right here. But it's in the knowledge. It's in you have to use the knowledge to turn it into wisdom. It's all right here. The proof is in the pudding. I'm not making this stuff up. But I did dig to find it though. All right, so we're going to go into a couple banking facts. Banking fact number 1. Money doesn't have to be intrinsically valuable, be issued by the government, or be in any special form. And who said that? This is David H. Friedman from the publication I Bet You Thought, published by the Federal Reserve Bank of New York, 4th edition. Money doesn't have to be intrinsically valuable, meaning it doesn't have to be backed by a commodity or, backed by any kind of resource. It doesn't have to have intrinsic value. be issued by the government. You don't need the government to give you a grant or be in any special form. So it doesn't have to be what? De facto, it doesn't have to be Federal Reserve notes. It doesn't have to be what? A money order, check. It could be a promissory note. Remember what we looked at, what money equivalents are, what monetary instruments and financial assets are. All of these things are money. Banking fact number 2, and this is going to go into the accounting that we just talked about. Banks create new money by depositing IOUs or promissory notes, offset by bank liabilities called checking account balances. We're going to read that part again. Banks create new money by depositing IOUs or promissory notes. Depositing. They create new money from the deposit of your note. Offset. Set off. Offset. Set off by bank liabilities. So that means the bank has a liability to you called checking account balances. So this is saying once you deposit $100 IOU, it's offset by a bank liability that's $100 in your checking account, right? So if they're depositing promissory notes offset by a bank liability, where the hell is your money? Right? All right. Contains standard bookkeeping entries demonstrating that money ordinarily is recorded as a bank asset, while a bank liability is evidence of money that a bank owes. The bookkeeping entries tend to prove that banks accept cash, checks, drafts, and promissory notes, credit agreements, assets as money deposited to create credit, or checkbook money that are bank liabilities, which shows that absent any right to set off, banks owe money to persons who deposit money. And this is not some shit I made up. This is from Anne Marie L. Gonzi from the Federal Reserve Bank of Chicago, from the publication Modern Money Mechanics, published in 1992. So again, it's not nothing that I made up. It's telling you right here. Banks owe money to persons who deposit money. So if you deposit an IOU, it's money. So where is the money that the bank owes you from your deposit? Now, if that's exchange for the house, okay, well, that's fine. You pay for the house. It's already paid for. So you don't owe anything. So you don't need to give anybody security interest for a mortgage. You don't need to give anybody security interest to come and get your car because you've exchanged one debt for another. You funded the whole thing. Go get your money. You might be wondering, okay, well, how did this happen, right? How did they just pull the swindle off on me and how did this happen? Well, sir, ma'am, you signed as an accommodation party. You agreed to take their debt and to pay it. Pretty much is what happened. I'm going to show you though. I could show you better than I could tell you. All right. UCC, Uniform Commercial Code 3-419. Instrument signed for accommodation. Now I'm going to go over this part, and then we're going to go into a remedy that everyone is entitled to use. However, you're going to have to, subscribe to the site to get access to that section, that portion of the video for the full version. But you'll have it forever, and you'll be able to access me as well if you need any help with any of this stuff. But they were able to pull this off on you because you signed an instrument for accommodation. All right? And you had no clue. You ain't even know it. You don't even know. All right, check it out. A, if an instrument is issued for value given for the benefit of a party to the instrument, the accommodated party, and another party to the instrument, accommodation party, signs the instrument for the purpose of incurring liability on the instrument without being a direct beneficiary of the value given for the instrument is signed by the accommodation party for accommodation. Okay, we're gonna unpack that for a minute. Another party to the instrument, which is you, right? Because the instrument is issued for value. They give you a value, a promissory note, right, for say $50,000, issued for value, given for the benefit of a party to the instrument, right? Which is they're claiming to be the beneficiary. This is where the swindle happens, right? And another party to the instrument, you're the only one signing it. Keep this in mind. This is your instrument, right? Signs the instrument for the purpose of incurring liability. So you're signing it to incur the liability. You're saying, okay, I'll take it. I'll take the liability, right? It's signed by the accommodation party for accommodation. B, an accommodation party may sign an instrument as maker, which you are, drawer, acceptor, or endorser, and subject to subsection D, is obliged to pay the instrument in the capacity in which the accommodation party signs. Right? So you're signing and you're obliged to pay as maker, drawer, acceptor, or endorser. The obligation of an accommodation party may be enforced notwithstanding any statutes of frauds and whether or not the accommodation party receives consideration for the accommodation. See how tricky, see how fast they just went? See how you just been hit and didn't even know you just got hit? Whether you receive consideration for your accommodation or not. That's some pretty slick shit if you ask me. C, a person signing an instrument is presumed. Here's this word again. This whole system works under assumptions and presumptions, okay? You need to get a grip of what's going on. Until you rebut the presumptions or the assumptions that they're making, this is going to continue to happen. A person signing an instrument is presumed to be an accommodation party, and there is notice that the instrument is signed for accommodation if the signature is an anonymous endorsement or is accompanied by words indicating that the signer is acting as surety or guarantor with respect to the obligation of another party to the instrument. So it's saying, okay, you're acting as surety or guarantor with respect to the obligation of another party to the instrument, right? So you're saying, yeah, I'll take on their debt. I'll take the debt that they owe me and I'll pay it. I'll pay it back to them. Except as provided in section 3-605, the obligation of an accommodation party to pay the instrument is not affected by the fact that the person enforcing the obligation had noticed when the instrument was taken by that person that the accommodation party signed an instrument for accommodation. Right? So if, okay, you say, well, you had noticed that I was signing the instrument and I was taking it, as an accommodation. Whether you had noticed or not, and you signed that instrument without rebutting the presumption, hey, now you're liable on the instrument, right? And that's just how fast the swindle happened. It's grimy, right? It's grimy, I know. All right, D. If the signature of a party to an instrument is accompanied by words indicating unambiguously that the party is guaranteeing collection, this is important, guaranteeing collection rather than payment of the obligation of another party to the instrument, the signer is obliged to pay the amount due on the instrument to a person entitled to enforce the instrument only if 1. Execution of judgment against the other party has been returned unsatisfied. 2. The other party is insolvent or in an insolvency proceeding. Remember, everybody's insolvent. They took your property, monetized it. That's where they got the money. They didn't have any money. They didn't loan you any money. They didn't give you anything. So everything can be considered, this whole system is ran under a bankruptcy. 3, the other party cannot be served with process. Or 4, it is otherwise apparent that payment cannot be obtained from the other party. Right? So if the signature of the party to an instrument is accompanied by the words saying you guaranteeing collection rather than payment, still obliged to pay the amount due, unless you can prove, this is the one I would go with here, the other party is insolvent or in an insolvency proceeding, because that's what the 26th chapter 11 reorganization plan 26 is. But wait, there's more. There's more to this crooked shit. Hold on. Hold on tight. All right. E. If the signature of a party to an instrument is accompanied by words indicating that the party guarantees payment, or the signer signs the instrument as an accommodation party in some other manner that does not unambiguously indicate an intention to guarantee collection rather than payment, the signer is obliged to pay the amount due on the instrument to a person entitled to enforce the instrument in the same circumstance as the accommodated party will be obliged without prior resort to the accommodated party by the party entitled to enforce the instrument. And I know this sounds like a whole bunch of, it probably makes your head hurt just listening to me say it, because it's said in such a condescending way. It's like, it's said, it's not straight talk, it's like double talk, you feel me? And the double talk is pretty much the way that they're swilling you out the money, because if they just came out and told you, like, look, if you sign this as an accommodation party, you're pretty much telling us that you want to pay us the debt that we owe to you. But if you want to say that you're guaranteed a collection, then okay, you're still obliged to pay us the money that we're supposed to pay you, unless you can prove that XYZ exists. So it's some shit all the way around, for real. All right, so check it out. Now the proof is in the pudding. I just said that. I told you. The proof is all in the pudding. Now look at this. F. An accommodation party who pays the instrument is entitled to reimbursement from the accommodated party and is entitled to enforce the instrument against the accommodated party. In proper circumstance, an accommodated party may obtain relief that requires the accommodated party to perform its obligation. This is supposed to be an accommodation party. I think I did a misspell right there, but all right. Obtain relief that requires the accommodated party to perform its obligations on the instrument. An accommodated party that pays the instrument has no right of recourse against and is not entitled to contribution from an accommodation party. So I'm gonna read it again because I got a couple misspellings in here. Okay, an accommodation party, you who pays the instrument is entitled to reimbursement from the accommodated party, them, the corporation, or whoever it is, right? Why would you be entitled to reimbursement? Because this is not your obligation. It was never yours to pay. Okay, so you're entitled to enforce the instrument against the accommodated party. In proper circumstance, an accommodated party or accommodation party may obtain relief that requires the accommodated party to perform its obligation on the instrument. So, you, the accommodation party, you have to just, never mind the misspell right here, it's supposed to be accommodation party, are going to attain a relief that requires them, the accommodated party, to perform its obligation to you on the instrument. An accommodated party that pays the instrument, them, so if they go ahead and pay the instrument, they have no right of recourse against, is not entitled to contribution from you, the accommodation party. That just proves it in a nutshell that the debt was never yours. These are government obligations. They are not your obligations. These corporations are indebted to you. You are giving them your financial assets. You are giving them your financial assets. They're taking it, making hella money on the primary and on the secondary markets. And after they're making their money on the primary and secondary markets, they're keeping all of the proceeds because you're not expressing any interest in the proceeds. Then they're giving you the debt that they owe you to pay back to them. Ain't that some shit? If this don't piss you off, make you angry, have you ready to act. Now don't go, look, I can't tell you what to do or what not to do, but don't go tricking yourself off the streets, you feel me? Be strategic. Be smart. I hope this fuels you to want to take action. Excuse me. Take action and go get your proceeds. Go get everything that is owed to you. And I'm going to go into remedies as far as using the United States Code to assign these debts to the government. And you want to tie in these corporations along with it on your bill of exchange and use the government as a case in need. Use the Secretary of the Treasury as a case in need. Use your local county treasurer as a case in need. So you're not going back and forth with these people. If they got any questions, hey, you go see the people you go see the trustees that's obligated to take care of these obligations of the government for me. And people said that there was no proof that this shit was prepaid. There was no proof. They needed more proof. And, you know, they talk all this shit about people that really have gone in the mud to pull this shit out. But instead of trying to grasp the concepts and study this shit for themselves, when we present it to you, hey, we get the bad end of the stick. We're the conspiracy theorists, or we're the sovereign citizens, or we're XYZ. No, fuck all that. We people that are putting our lives on the line to try to help you. And if you can't see it, can't see the value in it, well, you just need to move on and keep doing what you was doing. Okay? Because I'm not putting my life on the line and jeopardizing everything that I got going on for people that don't want to take this shit serious. This shit is very serious, as you can see. Feel me? And you can see that I'll just disprove anybody that says that this shit is fake or this is a scam or some kind of, some kind of a scheme or something that we're running, that I'm running. The only scam and scheme is what's happened to you in your contract. But you didn't even know. They hit you so fast with it, so slick with it, you happily signed up for the debt and funded the whole shit at the same time. So, look, you can do what you want to do with the information. like I said, I just went through and disproved any kind of attorney, anybody, any kind of attorney, lawyer you want to get that want to come, think they can disprove this shit, say that this ain't real, this is not facts. Well, they lie for a living, so expect that from them first. But they can't do it. Just like I put up the thousands, I told them $5,000 if any of y'all could find me democracy in any of the state constitutions or the Constitution for the United States. Nobody did it. Everybody just went silent, called me crazy, right? But one thing they couldn't never call me is a fucking liar. But they can't say the same for themselves. Y'all be the fucking best.